Hey, this is Alex Astley, and it's episode number 124 of Money Hacks. And after two incredible years of market performance in 2023 and 2024, for the first time in a while, we're starting to see a heightened level of volatility in U.S. stocks and in the markets overall. That's right. In 2023 and 2024, the S&P 500 index, the 500 largest U.S. companies, were up over 20% each year. Now in the first quarter of 2025, the market's been much more volatile, more ups and downs. And in the last 3 weeks, we've seen quite a bit of a sell-off, even into a correction territory, down about 10% in some of the major stock indexes. Now, first of all, we know that investors get worried. This can be a really unnerving period when you start to see more of that volatility in the markets. You start to see your retirement accounts or other investments go down. Right now, it's driven by a number of different factors, including tariffs, trade conflicts, heightened geopolitical risks and uncertainty, persistent inflation, and again, the fact that we've just had a number of good years in the market, and at some point you start to see a bit of a cooling off or a pullback. But as investors, it's really imperative to focus on the core tenets of long-term strategies to ground us into making the most appropriate decisions for our own investment portfolios. And first of all, I would say that volatility like this is part of the cycle. This is a normal part of investing in the financial markets. Although we've had a couple of years where the volatility or the downdrafts through those years have been relatively shallow, typically over the last 40 years, on average, you see the market go down in negative 14% per year inside of a given year, even though over that same 40-year period, the average annual return is a positive 10%. So in most years, even good years, we usually have a period where the market goes down some. And that could be what we're experiencing right now. Second of all, focusing on your long-term retirement goals. If this is money that you're setting aside, that you're investing into the markets for 10, 15, 20 plus years down the road, and if you have a mix that aligns with that time horizon, then you might not need to do anything. It's probably a prudent allocation. But ensuring that you're invested in a way that matches your age and time horizon is key. We absolutely suggest that you review your investments and ensure that they're allocated appropriately. If it's money you're going to use in the next 5 years or you're going to retire in the next 5 to 7 years, then we want to make sure that you've got enough cushion in that portfolio to protect the money you've accumulated. The third message, time in the market matters. Over the last 20 years, if you missed out on just the 20 best trading days, your account value would be 70% less than if you had remained invested every single day over that period, including those 20 days. So while sometimes it feels like we need to get money out of the market when we see it going down and then we can get back in later, timing the markets, trying to time when to get in, when to get out of investments or the markets overall is very difficult, if not impossible. You've got to make two perfect decisions. And for most investors, that's not possible to do, even seasoned investors that follow the markets every single day. So remaining invested during these periods generally provides long-term appreciation return above and beyond getting in and getting out of the markets. And finally, focusing on your specific financial picture, reviewing your accounts, ensuring that they're set up correctly, but not reacting to short-term impacts in an emotional way. If you have questions about your specific retirement account or your overall financial picture, or you want to learn more about what's happening in the markets or what you're actually invested in, please feel free to reach out to us for a one-on-one coaching session, and we'll see you next time. Thanks.